We are live. It is April 3rd. Not a great day in the market if you are in the stock market.
No, no, it's not been a great day in the stock market.
Yeah. Our location today is Arcto's Coffee and Roasting Company. It's on Hamilton. Actually, really good coffee.
It is good
Really good
coffee.
coffee.
Yep.
Sorry to Starbucks for cheating on you, but I'm here today. But we're going to update on March numbers for real estate, mortgages, and then also, like, I'd love to talk about just the tariffs and the potential impact that it has on real estate and interest rates. And we're going to do a special video that will probably separate from this on real estate investing and some of the benefits of real estate investing. Kind of take a look at, just kind of the historical rates of return on real estate. And we'll put that chart in the newsletter for you guys to look at too. But just starting off, as far as activity for the month of May, prices were really stable, down 0.06 or 0.6% for the month of March. So month over month, year over year, down a little less than 1%. We saw closed sales tick up almost 16% month over month, but those are still down 10% year over year. What I think is interesting is the new pending sales, which is a leading indicator of real estate activity for the next 30 to 60 days. Pending sales were up over 42% month over month and are up over 21% year over year. The other cool thing was is new listings. We saw those jump up 52% month over month and 21% year over year. So getting a little bit of inventory back and people actually active in the market on real estate, which is nice to see.
Yeah, and I think the great thing about having the inventory is you might have a few things to look at. We're not in a super tight market, so I think that's really advantageous for the buyer.
Yeah. So with regards to interest rates, where are those at right now? And I'd say a follow-up question, how do you see the tariffs, if any, impacting rate?
So, I mean, if we want to look back into March, interest rates were pretty stable, right? They stayed pretty much flat. We had talked a little bit about it in our last video about how they were about as low as they had been since last September. And when you had to go back almost 2 years to get to where the rates are today, they've stayed fairly stable through March. Obviously, given the fact that we had our liberation with tariffs yesterday, the markets have reacted to that. Interest rates are slightly better today. I think there is still a lot of question of what the long-term effect of these tariffs are going to be. I think you can read news lines that say we're going to enter a recession. I don't know if that's going to happen, but I can tell you, typically speaking, a recession has been very good for mortgage rates and very good for home buyers. Home buying activity is actually, as hard as it may sound, actually increases usually during a recession.
Yeah. And I think like I was reading an article yesterday and like projection with tariffs or one potential outcome with tariffs is that it actually increases inflation. And if inflation goes up, the bet is that the likelihood the Fed reduces rates for the overnight rate, which would be potentially beneficial for mortgage rates.
Yeah, the other thing that could happen with tariffs if it would slow spending, which actually may bring inflation down if people are buying less goods and services. So, I mean, there could be, from a mortgage rate standpoint, some real positives up with the tariffs.
Yeah, I agree. So switching gears just a little bit, I wanted to talk about real estate investing. And like, I mean, the timing, it's probably decent timing with the market being down or the Dow being down 1,600 points today. Want to go over some of the benefits of real estate investing and take a look at history because history tends to repeat itself. And so taking a look over the last 75 years of returns for real estate, and I think there's some surprising data in there. So one of the biggest advantages of real estate, in my opinion, is leveraged appreciation, meaning like you can buy a $400,000 asset for, if it's an investment, 20%, 25% down. So on $80,000, you get that's your cash out, but you get to take advantage of the full amount of appreciation. And so let's just say it's 5%. So you buy a $400,000 house, next year it's worth 420, but that 20% on your 80 grand that you put in, your cash on cash return is 25%.
Yeah, I mean, I think one of the things I looked at when I had a house rental was I had put down to 25%, and my return was at 20 to 25% because two things were happening. One, I was paying down the loan every time, so that was increasing my net worth. And two, it was appreciating every year. So really, the return was somewhere between 20 and 25%. Because even I didn't pay 400. I mean, I paid $400,000 for the house, but that is, in my case, I'd put $50,000 down and was making $500 a month in rent and I was paying down my loan $500 a month, and then there was appreciation. So I mean, there's a real benefit there.
Yeah, and I mean, if you look at stocks or mutual funds, you buy $80,000 worth of stock, you get X number of shares. And if that stock goes up 10%, your return's 10%. If it goes down 10%, your return is negative 10%. With leveraged depreciation, your cash on cash return, so deploying that $80,000 is much higher than even I mean, what you're going to see in the stock market. And that's not even including the amount of money that you would make. So if it's $500 a month, you get an extra 6 grand a year in what could be tax-free income. And that leads me to like the next benefit, which is depreciation.
Yes.
You can depreciate a house over 27 and a half years when you own an investment property, or, and it's kind of sunsetting, but you can take an accelerated depreciation. So if you're a higher income earner now and you want to do an accelerated depreciation, I think you can depreciate, I want to say it's like 70 or 80% of that, 27 and a half years within the first 5 years.
Yeah, it can really lower your tax burden, which also, once again, helps. It's basically added income. If you're paying less taxes, you've increased your income. So depreciation is a powerful tool.
Yeah, and so depreciation directly offsets your income. So you're taking your $400,000 house and you're saying, because of wear and tear, essentially, the actual structure of the house is worth less by whatever percentage that works out. So let's just say in year one, you have $4,000 worth of depreciation and you net $6,000 from rental income. You're only taxed on the $2,000 because it's a direct offset
Correct.
of income.
It's an expense.
Yeah.
It's no different than property taxes or homeowners insurance or anything like that.
Yeah. I'd say the third benefit, and we don't have to cover every benefit, but the third benefit is the lack of volatility in real estate.
Yeah, I mean, fundamentally speaking, there has not been much volatility. There hasn't really been any volatility in like 16 or 17 years since the Great Mortgage Meltdown, which, was a blip in the radar if you look over like what you're saying over a 75-year period.
Yeah. And if we look at a 75-year period, so we printed off a chart that goes back to 1950. And the interesting thing is, out of the 75 years, there's only 7 years that had a negative return in real estate. First was 90 to 91, and that was a direct result of Desert Storm.
Yep.
And even at that, it was down less than 1% in total between those 2 years. The next would be 2007 through 2011. And that's the only time that real estate, as a direct result of real estate or mortgage, has actually declined.
Well, but the interesting thing about that, because I've lived in my house and I lived through that time, because I didn't sell my house, even though the value went down on paper, it is more than gained that over the last years. I've been in my house for 20 years, so I didn't feel that loss, right? I didn't. While it was there, it didn't affect me at all. Actually, my house is worth a lot more than I paid for it.
Well, and the thing is like, if you look at risk, so if the market, let's just say you had $400,000 in the market and the market went down 12%. By the way, there was only 1 year that real estate had a double-digit loss, and that was 2008. Only 1 year in that 75-year time period. So on 400 grand, if you're down 10%, that's $40,000. But because it's leveraged, you don't experience that full result on your money.
No,
whereas in the market, you do.
Yeah, I think the key to the example we're using is you get a $400,000 asset for $80,000 out of pocket.
Yep.
And quite honestly, if you're renting it, someone else is paying for your mortgage anyway.
Yeah. And Spokane is very much, just to kind of put a bow on this, and then I wanted to run a mortgage or a lending option by you that I think that, like, great for the consumer. Spokane's definitely a check your local weather, don't listen to the national weather, because in 2008, when nationally prices were down 12%, we were down less than 10%. I can't think of a time where we had double-digit losses here in Spokane.
No, I don't think we did.
No. So here's what I think is the coolest product right now. What I'm personally doing with rental properties right now is I'm using DSCR.
Great product.
And DSCR doesn't care about my income. So in an environment where like debt to income ratios are higher, all of that, like, we have so many challenges of entering into the real estate space. But as an investor, DSCR works because it's more concerned with the property's ability to cover the debt.
Correct. It's all it's concerned about. What DSCR does is bring to residential real estate what has happened in commercial real estate for years. At the end of the day, they're not as worried when you buy a commercial property as if you can make that payment. They want to know if your tenant's going to be on, what your rent is going to be, and can you cover the payment. It's a great way to get into it. You don't have to have the income to qualify to buy an investment property.
Yeah, it's a credit score. I don't even think I have to turn in my tax returns. And so I have to
And
show,
assets.
yeah, I have to show assets to cover for like whatever the reserves are. And I have to show a lease.
Yep.
That's it. And I mean, it does
Yeah.
not get any easier to
No.
enter into the investment market than it does with a DSCR product.
No, it's the simplest one there is.
Yeah. And I think rates right now on those are sub 7. I mean, I've seen some that are sub 7.
Yeah, depending on the coverage ratio and the down payment, those rates aren't that far off what a conforming conventional rate is.
Yeah. So I think from a strategy perspective, just kind of put a bow on it. If you're looking to offset income, if you're looking to reduce volatility, if you're looking to get a potential higher rate of return than what you've been doing, I want to talk. And my personal cell is 509-435-3287. Happy to answer any questions, talk strategies, connect you with Mike. Mike will give you his number as well. But I cannot think of a better time to own real estate than right now, or yesterday, actually.
Yeah, right. The best time to buy probably would have been yesterday.
Yeah.
I can be reached at 509-747-1300. It will also ring to my cell phone.
Awesome. So we'll be back next month. We're going to have a different location, probably another coffee shop, since no beer for me. So we'll pick another coffee shop and update you guys on what's going on in April. Update you with any client stories around the investment side. I really, really cannot strongly stress enough. I think, as far as buying real estate as an investment, there are so many benefits to it, and love to chat about those.
Yeah, and I would agree with Rich, and I do own investment properties.
Yeah, same.